Hi everyone! In this video, me, Eunike Afni Putri Singarimbun, and my teammate, Mispa Christin Siregar, will explain you about the global economic landscape, understanding indicators, global trends, and monetary policy. I hope you all enjoy watching this video. Why economic indicators matter? Economic indicators are essential tools that help us. First, evaluate the strength of a country's economy. Second, observe labor market conditions. Third, identify inflation pressures. Fourth, understand customer and business sentiment. And the last, analyze trade performance. They act as a health check for the overall economy. GDP, the core measure of economic activity. Gross domestic product, or GDP, represents the total value of goods and services produced within a country. Important aspects to analyze are real versus nominal GDP, quarterly growth patterns, sector contributions such as industry, services, agriculture, long-term growth trajectory. GDP tells us whether an economy is expanding, stagnating, or contracting. Labor market indicators. The labor market reflects economic strength. Unemployment rate. Official unemployment includes underemployment and discouraged workers. Job creation, like monthly job additions, growth across different industries, quality and stability of new jobs. Also, wage growth. Increases in average earnings, real wages, and purchasing power. Income distributions, concern. Understanding inflation. Inflation measures the general rise in prices over time. Key indicators: Consumer Price Index or CPI, mean cost of living. Producer Price Index or PPI, mean production and wholesale cost. For inflation, mean excludes food and energy for clearer trends. Personal consumption expenditures, or PCE, is widely used by central banks. Confidence indicators. Sentiment indicators provide early signals for economic direction. Consumer Confidence Index means willingness to spend manufacturing or business. PMI mean expansion more than 50 or contraction less than 50. Retail sales growth means strength of consumer spending. Trade and currency conditions. Trade balance show whether a country imports more or exports more. Exchange rate movements influence inflation and export competitiveness. Current account includes goods, services, and international income flows. Global economic trends. Digital transformation. Digitalization continues to reshape global economics. Rapid expansion of e-commerce, hybrid and remote work changing urban space and business models. Also AI and automation improving productivity but shaping job structures. Fintech innovation challenging traditional banking system. Demographic dynamics. Population changes greatly influence economic policies. Like aging population in advanced economy. There is shrinking workforce and higher healthcare costs. Youth-dominated population in developing countries. They have potential demographic dividend. And migration flows help fill labor gaps but bring social and political challenges.
The new supply chains have shifted after recent global disruptions. Production relocated closer to markets. Companies maintain more safety stock. Diversification reduces reliance on a single supplier or a country. The economics of sustainability climate change now shapes economic decisions. Large investment in renewable energy and green technology, carbon taxes, and emissions trading systems. High risk of fossil fuel assets losing long-term value. Inequality and inclusive growth. Economic inequality continues to rise, with wealth increasingly concentrated among low-income groups. Technology raises demand for skilled work Policy responses: progressive taxation, universal basic income trials, workforce retraining. Central banks and monetary policy. What are central banks aim to achieve? Central banks stabilize the economy through: number 1, inflation control, commonly 2% target, employment support, setting benchmark interest rates, managing liquidity through QA and QT, curing markets via policy signaling. The interest rate cycle recent monetary policy developments. Ultra-low interest rates and after the pandemic rapid rate hikes to control surging inflation. Rates help hike until inflation stabilizes, potential rate cuts when economic activity slows. Different monetary approaches worldwide. Number 1, United States Federal Reserve, prioritizing inflation reduction. European Central Bank, ECB, balancing inflation and energy-related risks. Bank of Japan, BOJ, maintaining ultra-low policy to escape long-term deflation. Challenge in controlling inflation. Central banks face obstacles such as: number 1, global supply chain disruptions, energy price volatility, tight labor markets, policy effect that appear with long delays, 12 or 18 months. Financial stability risk. High interest rates can create vulnerabilities. Declining value of stocks and bonds, stress in the banking sector, higher refinancing pressure for heavily indebted companies. Conclusion: the global economy is evolving rapidly. Understanding indicators, global trends, and monetary policy help us predict economic directions, make informed financial decisions, support sustainable and inclusive growth. Thank you.